Islamic banks in the Abbasid Caliphate can be traced back to the 8th century, when the first Islamic banks were established in Baghdad. These banks were known as Bait al-Mal, which literally means house of money. They offered a range of banking services, including loans, deposits, and exchanges, and they were state-owned and run. Islamic banks played an important role in the economic development of the Abbasid Caliphate. They provided the capital needed to finance trade and investment, and they helped to promote economic growth. Islamic banks were also responsible for the development of a number of new financial instruments, such as the bill of exchange and the letter of credit. The Abbasid Caliphate was a golden age for Islamic banking. Islamic banks were able to flourish because of the strong support they received from the state and the general public. Islamic banks were also able to benefit from the stability and prosperity of the Abbasid Caliphate. However, the Abbasid Caliphate began to decline in the 11th century, and Islamic banks suffered as a result. Political unrest, economic decline, and military defeats were a few of the causes of the Abbasid Caliphate's decline. Islamic banks continued to operate in the Abbasid Caliphate until the 13th century, when the Mongol invasion brought the caliphate to an end. The Mongol invasion was a devastating blow to Islamic banks, and many of them were destroyed. Despite the decline of the Abbasid Caliphate, Islamic banks continued to operate in the Muslim world. Today, Islamic banks are a major part of the global financial system. There are now over 1,500 Islamic banks operating in over 60 countries around the world. The history of Islamic banking in the 19th century is a complex and multifaceted one. On the one hand, there was a great deal of continuity with the past, as Islamic banks continued to operate in many parts of the Muslim world. On the other hand, there were also a number of important changes, as Islamic banks began to adapt to the new political and economic realities of the time. Here are some of the key features of Islamic banking. Islamic banks are based on the principles of Islamic law, which prohibits usury, Riba. Islamic banks offer a variety of banking services, including loans, deposits, and exchange. Islamic banks invest in assets that are considered to be halal, permissible, under Islamic law. Islamic banks avoid investing in assets that are considered to be haram, forbidden, under Islamic law, such as alcohol and gambling. Islamic banks share their profits with their depositors and investors. Islamic banks have played a significant role in the development of the Islamic world. They have provided the capital needed to finance trade and investment, and they have helped to promote economic growth. Islamic banks are also responsible for the development of a number of new financial instruments, such as the Islamic bond and the Islamic insurance contract. Islamic banking has grown rapidly in the 20th and 21st centuries. It is now a major part of the global financial system, with over 1,500 Islamic banks operating in over 60 countries around the world. Islamic banking is based on the principles of Islamic law and offers a number of benefits to customers, including ethical and socially responsible banking, financial inclusion and economic development, and resilience to financial crises.